Good evening, everyone. So let me briefly talk about this particular podcast that we are doing. We have a very reputed speaker today with us, Christopher Grune. He began his career working for a member firm at Chicago Board of Trade, now CME Group, and he has over 30 years of experience in both finance and IT in three continents: Asia, Africa, and North America. He holds an MBA from Columbia Business School, New York. He is CFA charter holder and CQF as well. He served for many years as a founding society member or as a board member for the CFS societies of Japan and both East Africa. And he has worked for some of the world's largest institutions like Citi, Societe Generale, State Street, and World Bank, IFC. And he has particular interest in Indian and emerging markets as well. So he has actively traded in Indian markets in equity, FX, and fixed income, lot of it across asset classes, managing billions of dollars. So today we are, and he's a quant portfolio manager who deals with AI, ML, and all those kind of stuff. So today we have invited Mr. Chris to focus and share his global experience, talk about so many aspects from fundamental, traditional approaches, and then quant, AI, and ML, all those kind of stuff. So Chris, let's first start with, you want to say hello to the audience?
Yes. Thanks everyone for joining. Thank you for that kind introduction, Pankaj. Yeah, I've got I'll just also just maybe add a little bit to the introduction. I have a little bit of an unusual background because I've done so many different things in finance. I've worked on trading desks as a trader. I've I've actually, yeah, I was on the floor in Chicago when it was still open outcry, and that sort of craziness. I've done across all asset classes, forex, bonds, stocks, commodities, um, and then I've also, even on the consultancy side, I've been kind of doing some investment banking and corporate finance and project finance. So yeah, I guess I feel like I've done a little, pretty much everything that there is to do in finance. And yeah, and I used to manage around, I guess at the time it was 10 crore in emerging markets, with about, let's say, roughly 10% of that in India. So, but yeah, I've only came to India for the first time a few years ago. I was very happy to do that, and yeah, look forward to the discussion tonight. Thanks,
Yeah,
Pankaj.
yeah, yeah. So let's first start with a very interesting topic that you have seen global market, you have seen Indian markets. So how do you differentiate between, based on your experience, compared to the Indian markets, emerging markets, compared to the global market experience that you have?
Yeah, uh, I did trade developed markets. So I was working out of Citi's headquarters, dealing with U.S. markets. I worked in Tokyo dealing with Japan. So I have experience in the developed, the I would say, the developed markets. Yeah, there's always, I mean, every country is different. Every country, you don't just, you don't just set up an account and start trading the same that you would, with I would say, the developed markets. There's always some friction. There's always some peculiar thing that you need to deal with. So I'd say, yeah, I mean, this is one of the things you need to know the market that you're trading. And uh, yeah, and so and I've worked in some very illiquid markets. I've traded Africa, which those markets are pretty illiquid and have a lot of their own. Each country has different treatment of investors. So yeah, I would say just know your market. Don't assume that it's the same as everywhere else. Yeah,
Yeah, great, great. So let me tell you that the quant strategies are in the emerging phase in India, and most of the people are generally used to do the fundamental type of investing, traditional way of approaching. And quant has a very good scope in India based on the trends that we are seeing. And so I just want to understand, I just want audience to share with the audience that how do you think that quant as a strategy can help improve the traditional fundamental approach of investing and or in vice versa. So how do you think, how do you see these two fields, quant and traditional fundamental approach as in a complementary way?
sure. Yeah, I think they fit together very nicely. If you go further back, and again, those of us who have been in the industry for a long time, we used to have, before we had quant, let's say before we used to call it quant, we had technical analysis, right? Which was the study of charts and coming up with, complex patterns for momentum and things like that. So, and then you had traditional fundamental analysis, analyzing financial statements and just trying to pick good, profit making, very, solid, financially solid companies. And then I would say quant, in fact, when that really started to become more, it was published in a lot of research papers, and then funds managers actually started using it. I would say it's kind of a blend of those of fundamental analysis and what we used to call technical analysis, and then everything else. And all quant really is a process. It's just imposing a technical quantitative process to your management, your fund management. So, yeah, I think it's definitely here. And actually, I'll also give a little bit of perspective, because um, when I first started in emerging markets, it was sort of the mid '90s, and no, sorry, it was 2000, mid 2000, let's say. Um, Quant was still relatively new for emerging markets, and there were a lot of people who said you can't use quant in emerging markets. Not enough data, not enough long enough history, too illiquid. We had a lot of criticism about using quant in those markets. And you look where we are now, where I'm sure I think probably at least half of all the assets under management in emerging markets are probably being run by a quant system. So yeah, the market and the industry has definitely evolved.
Yeah, so thanks for sharing that, because I personally believe that say even in the fundamental side, if we look at the financial ratios, balance sheet, and there are lots of companies, thousands of companies. So definitely, quant can be very helpful in analyzing even the balance sheet data, even the fundamental ratios, financial ratios. Even artificial intelligence, machine learning, and all those things are quite very useful for on the fundamental data as well. So quant can be seen as a process of analyzing the data. Maybe it could be fundamental data or trading data or technical any data. So how do you look at that from that perspective?
You raise a really good point, Pankaj, and this is one of the big advantages of using a quantitative system. It's that you can analyze and potentially include in your portfolio so many more companies, so many more stocks. Um, the traditional fundamental approach, and we still have, let's say, industry or sector teams of analysts, in the big investment banks. But if you're let's say you're an oil and gas analyst, or you're an IT, technology analyst, the most companies you can cover are, let's say, seven, eight, maybe even 10 companies. And so then you give your opinion on which out of those seven or 10 companies, which ones are the best ones for your industry. Um, and then and so it's very narrow. And that's the thing. I mean, Quant allows you to look at thousands of stocks. You develop a system, and you can potentially invest in thousands of stocks, and try to find the best names, the best stocks in that universe. So yeah, it's actually quite powerful in that sense, that you can go much broader.
Yeah, so for example, I was talking to some of the global experts that even say, for example, if we are trying to find the value stocks, okay, we generally do by say price to book ratio, book data, a lot of different financial ratios. So even there, quant can be quite useful to find out the true value, and because the what kind of financial ratios we have to take, in what ratios we should take, which say suppose we have hundreds of financial ratios, which financial ratios may be quite useful for the market. So there can be definitely quant can be used applied on those areas as well. That's a very useful application of quant, AI, artificial intelligence, and machine learning on those kind of stuff. And do you think similarly? I will ask you. Say for we have talked about that quant is useful for the fundamental things. Do you think that fundamental aspect is also important for the quant managers?
Yeah, absolutely. I mean, I think the lines are blurred. It's kind of I mean, quant managers use fundamentals all the time. I mean, if you think about, like, just let's just say, like, a very simple ranking system of price to earnings or price to book, and your system, your model assumes that cheap valuation companies will outperform. That's You're using fundamental financial data in a quant system. So yeah, it's the lines are very blurred, and everything, like, you use information. That's the thing. I think nowadays, and this is gonna, probably we'll touch on this uh, afterwards, but this is where AI, machine learning, come in. But you take information from everywhere you can find it that you think will be useful, and then you just need to find a way to use it, to use that data.
Yeah, okay. So there have been many global reports as well that quantamental, where we combine quant and fundamental, it is going to improve it is going to be win-win for both the fields. So do you agree with that?
Yeah, I do. I do. I think that, I think that, anytime there's some new development, and I'll say also this, I would say AI and machine learning is not new. In fact, it's not new in
Yeah, yeah,
finance.
yeah, yeah.
We had, we were there were a lot of people sort of testing this out, and you could there were things like structural equation models, and genetic algorithms, and there were all sorts of, they basically optimize. They're complex methods of optimization, essentially. So, and we were trying these out in the 90s or in the 2000s, but the reason they weren't used at that time for a few reasons. So, wasn't enough data, didn't have powerful enough computers. We didn't have really good algorithms and tools. There was still very early days for those types of systems, and then also you couldn't explain it to clients. And this is one of the reasons that I think Machine learning AI is still moving a bit slowly because if you make money, they'll be happy. If you lose money, how do you explain it? And these machine learning models. That's I would say one of the problems or one of the obstacles is that they're not easy to interpret. How do you explain to your client? And at the end of the day, when you're a fund manager, you always need to be able to explain, what happened, why it happened. So there's still some hesitancy, I would say, with machine learning and AI.
Definitely, human intervention is quite important while applying all those artificial intelligence or machine learning kind of stuff. So rather than completely leaving everything on those
Yeah,
models,
wow.
yeah. So that's
And
very much
and
important.
Well, and human oversight, right? You need a sanity check. You need some human oversight. I have been on trading desks when, fortunately, it wasn't our firm, but we saw other firms that were executing algorithmic orders, and they made a mistake, and they ended up losing a lot of money. So I think we want to use the technology as much as possible, but I think we always want to have a human touch, some oversight.
Yeah, yeah. So that's one of the you can say risk of because some of the people are so much obsessed with technology that they sometimes tend to ignore the human supervision, and that becomes very crucial factor. So I think I agree that there should be a proper balance between the human side and the machine side in a very complementary way, and right set of balance is quite required. So so let me tell you a very important point. That is generally perceived and in the industry that quant is like churning too much. Okay, fundamental is like being very slow, and quant is like churning too much. So how do you see this? Is really quant about churning too much?
It's one of the criticisms. It's sometimes of quant is that right. It's generating too many trades, too much turnover, and when you have, let's say, if you have transaction costs. Well, in the U.S. and Europe, they've become, they could be very low, could be, 10 basis points or less on a trade. But in other markets, in global markets in general, I mean, every time you trade, each way you're losing, 50 basis points or 1%. And if you turn over your entire portfolio in a year, you've just subtracted 2%, 1 or 2%. So it has a real impact on performance. This is, trading at too much impacts performance. And one of the problem, well, I'd say sometimes problems with quant is that the signals change too often. So it's telling you to, we held this stock for a month. Now we have to trade out. We have to buy this other one. Um, so it's definitely something to watch, and my recommendation is to look for information that doesn't change that frequently. So you were talking about fundamental, where maybe, the information is updated every quarter, maybe once a year, depending on the company. So obviously you won't change your view that very often. So when you start using market-based signals, they can be very volatile. They can change very often, and that leads to more trades. So there are ways to, you want to blend your inputs. You want to make it stable, but reacting to changes in the market. So it's always a compromise. And then even the way you manage the portfolio, there are things that you can do to sort of slow down the impact of the trading. That we were discussing this the other day. Is that don't trade until maybe you're a certain distance or you're a certain threshold from your holding, or there are certain rules that you can apply that will also reduce the amount of trading. So I think quant has been adopted widely. People have figured out how to deal with this, and you can have a fast moving model, or you can have a slow moving model, or something in between. So um, it's something you figure out. You find what works best for your firm and for your clients.
Yeah, definitely. Because I personally find that based on my experience, that say, for example, if you are a fundamental manager is trying to find out the value, for example, based on the balance sheet or something like that, even their quant can be applied, as I talked earlier. So it's not just about fastness everywhere. Quant is just not about fastness. It's also about looking deep into the data. Okay. So it could be in the slow mode as well. So this perception that quant is always just for maximizing the speed, I think there is some misconception there out.
You
And
have to separate high frequency trading from quant. So they're two completely different things, right? High frequency trading uses, a systematic approach, and they use algorithms to generate and, send the orders and determine when to buy and sell. But that is very different from a quantitative portfolio management system. So a quantitative portfolio management system, and again, when you're trading in markets where it's costing you more to trade in and out, then you want to slow down. You don't want to, you want to trade less. You want to spend more time on your picks and hold them longer. So these are, yeah, I think people confuse. They think they're the same thing. They're really not the same thing.
yeah, yeah, sure. Yeah. So definitely both the approaches have their own pros and cons. So that's why a combined approach is very useful to improve. It's a win-win for both the fields. And it's just not about turning more and more means quant. Quant does not necessarily mean turning more and more. Okay, so this is a kind of misconception I often find some of the people often talk about. So 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 let's come to now factors. Factors is getting quite popular even in India. So factor-based strategies is a new buzz. People are looking at factors. So how do you look at the factors? Do you see it as a promising approach of quant?
Yeah, absolutely. No, I would say if it's starting to become popular here, I mean, we were using it in markets quite a while ago. It's become almost one of the, main methods of, both for risk and return. So you can build an alpha model, which, tells you what stocks to buy or how to construct your portfolio. And those are factor models in most of the time. I mean, anything can be a factor. So let's think about, like Fama French, where they looked at market cap, small versus big, or they looked at you know value, so book value, price to book, and these sorts of things. And I mean, they've been around for a long time, and I would say in the developed markets, they're widely used. And um, so yeah, I mean, it's a tool. It's a tool that can be used. You can build a model, either a risk model or an alpha model, using factors. It's just one of the tools in the toolbox. There are many other ways to construct models.
Yeah, definitely. But and one thing needs to be very careful. It's a precaution that we generally tend to apply statistical methods and all those things. And
Sure.
trying to find out the factors by looking backward into the data is quite easy. But which factors works forward is relatively quite difficult. Okay. So one has to be very careful just to decipher the factors, find out the factors just by statistical testing kind of stuff. So there has to be proper understanding. You might not be uh, getting into overfitting or just playing with
Yeah,
data and all kind of stuff. Because a lot of
absolutely.
times,
Yeah, and this is the same drawbacks to building constructing models. Um, there's it's an art. It's as much of an art as a science. So if you have like, if let's say you use 10 years of data for your model, it'll adjust slowly. And let's say you want something that adjusts more quickly, so you use daily over a month or something. I mean, you really have to think a lot These are not, every model is sort of customized for the situation. So yeah, you're right. I mean, and whether you look at time series, whether you look at cross sectional, I mean, there's so many different ways to construct these models, and it's again, it's a tool. It's a tool in your toolbox. It doesn't have to. Um, I think they're very useful, and I've used them a lot in my career. But they're not. It's not a magic wand, and machine learning for that matter is not a. There's no magic wand. You have to just try to find as many useful components and combine them.
Definitely. See, anything, these are tools, and anything, if in the wrong hand, it can be dangerous. So it ultimately depends on the user and the manager who how to apply these tools. I remember that in a global financial crisis, one of the statistical tools was by David Lee. It was Gaussian copula, find out the correlation and all those kind of thing, the probability of
Like
default.
a VAR, value at
Yeah,
risk, right? It
yeah.
causes a lot of problems.
Yeah, so all those things are quite useful, but the warning is that you have to understand how to use it, whether it is artificial intelligence, machine learning, quantitative models, everything. So anything, if even on the fundamental side, if the manager is not able to understand the things, where to use, what to use, when to use, it can be very disastrous. So definitely it's not a magic, but depending on who are the people who are actually using it, it becomes a magic. So it depends on the people side as well. Okay. So it's a combination of both human and some mathematics. Both the things are combined. So and these days, I was talking to one of the global fund manager. These days, it's not just about few factors like value, momentum, and all those kind of stuff. It's good, but there are hundreds of factors. Okay,
Yeah,
which are found out based on the artificial intelligence and modeling and all those kind of stuff. So how do you look at this factor Jew kind of thing?
right. Yeah, no, that's firms nowadays, they build factor libraries and they collect the data so that you can, yeah, you might have, 100 factors or more. Um, well, this is where sometimes, you talk about overfitting. And I mean, if you build a model on the fly, like if you build you basically look at which factors produce the best performance, over the next year, and then you choose those factors and then you use that model. Well, now uh, the market has changed. So you've picked based on this is always, it's kind of backward looking, and the market is always changing. People, it's very efficient. It's not completely efficient, but I mean it's very competitive. So yeah, again, if you can have as much data as you want, you need to know the pros and cons. You need to know how to use it. You need to know where it works well, and you need to know what the potential problems could be. So, um, yeah, definitely. I'm a data analyst type of guy. I'm a quant, so we all are, I think, on this call. So you always want more data rather than less, but then you need to understand how to use it.
Definitely, because we often use the word data driven and it's quite popular, but to understand the data is quite important rather than just have. There has been one study that if you say increase the number of data, for example, okay, that is not going to be much useful if you are not able to look inside the data. So
And
looking into the depth of data is also quite important in my view, rather than
yeah,
just having more and more data.
and look, I mean, I think as a quant manager, you don't always have this capability, or but I'll give you a specific example. We were combining. We had some people in the team which were sort of very fundamental managers, and then we had others, and I was one of the quants. And our model told us to take a big position in a particular company. And then I went to the guy who specialized in that region and that country. And he said, no, no. He's like, those guys are crooks. Don't like either don't buy anything or buy much less. And this was knowledge that he had from following, that company and that region, and had met with the management. And that's something your model will never tell you. So, I think there's always a kind of a fine balance between the two.
Yeah. So coming back to the factors, because factor is quite popular. How do you look at this factor timing? Do you think that factor timing really works, or and also the multi factors versus single factor? How do you look at all those things based on your experience?
Yeah, I mean, those are right. Those are kind of, you can make your model more dynamic. So um, I'll give a very kind of simple example is that let's say low price to book is working well, and then you have a model which then it switches, and then you should do price to EV to EBITDA. Or you may switch to a more of a growth, kind of a growth driven, like earning, EPS growth, or, and that's the thing. You can be constantly switching the factors in your model, but that just adds a whole nother dimension of, it's now it's changing a lot. It's not just the data that's coming into your model is changing, but then the factors themselves are also changing. So um, again, these are, yeah, you can make very, very sophisticated models. But also what I've seen in my experience is that, the most sophisticated models tend not to work. You want something that's kind of intuitive, that's as complicated. Einstein had this saying about, make something, or something, you use what needs to be as complicated as necessary, but no more. So in other words, you don't try to oversimplify. Uh, so you make it as complicated as it needs to be, but then don't make it more complicated, because then it just tends to lead you in the wrong direction. It's clients have a hard time understanding. So I think, yeah, there's like always like there's a middle ground that you need to find.
Yeah. And you have been talking about data. So what I personally find that one has to be very, very careful while looking at the data, because if you look backward, even if you take the random set of data and start doing some statistical analysis, you'll find some of the factors for sure. Okay. So even if that's a random point, so the point is that, and this is a very, you have to, while using data, you have to understand the challenges and limitations as well. Okay. Of looking at the data and the statistical tools. So they're definitely useful, but you have to be careful, because people, this is a psychological thing. We tend to be biased toward the backward looking thing, and we try to find out the pattern and all those things. And as you have very rightfully said, that factors keep on changing. Market is quite dynamic, so what works past may not work in future. But it's our psychology that we often tend to be very, very, so remember, you are a big fan of Paul Wilmot, and I was just talking to him, and he told me that about the history, that his statement was that people, if and glued to the history, but uh, those who love history uh, uh, too much are doomed to fail. It was his statement. So so history is important, but you have to understand the, because kind of history that you are observing, that's one of the many possible histories that could have actually occurred. Okay, that you don't see, and that's one of the challenges in the risk management as well. That we often try to figure out all those metrics by looking at the backward data, backward set of time series and all those things. But we do not often realize that what we are observing, that's just one of the many possible set of unobserved history that could have occurred but actually didn't occur. Okay. So it's so the modeler has to be very careful psychologically, that what exactly we are analyzing and how do we analyze the risk, kind of thing. So coming to the uh,
Yeah,
we
that
often we have talked. Yeah, please.
Mark Twain had a saying that history doesn't repeat, but it rhymes. So it's similar, but it's never going to be exactly the same.
Yeah, so we have to understand the difference between observed history and unobserved history. We often tend to be stick to the observed history, okay, but the real risk comes from the unobserved history, okay. So that is often ignored, okay. So 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 tell me, from the risk management perspective, how do you think, Miss, how useful is these factors and all those things from the risk management perspective?
Oh, very useful. I think they're very useful. I think they can tell you a lot. And again, there are many different types of factor models. They can be used for picking stocks, but they can also be used for telling what your risks are. So, you could have a model that says, your earnings growth, you have a big exposure to earnings growth. And then if all of a sudden the market doesn't like earnings growth. I mean, it usually likes earnings growth, but let's just say, like, you that's an exposure that you need to keep in mind. If you have big value tilt, or value bias, and you have a lot of cheap stocks, and the market decides it likes growth stocks and it hates cheap stocks, then you'll be punished for that. So that's on a fundamental level. You can also look at things like macroeconomic factors. So one of the things that we did at Citi was we would look at uh, inflation and GDP and oil prices, or credit spreads, and we combine a lot of things which they're not that popular, but I found them useful. And it could tell you sometimes that you think you buy a certain set of stocks and you see they're in these industries and you think you have a certain type of exposure, but then you run your risk models and then you find out, oh my gosh, these, you thought you had good diversification, but in fact you're really exposed to small cap, or you're really exposed to, maybe your companies are really at risk if credit spreads widen, right? And these are the kind of, it's the information that's not obvious, but then you run your risk models and it shows you things that yeah, and then you you can make adjustments based on that.
Yes, a few points I just wanted to mention because you talked about cheapness. I personally feel, I was even talking to one of my co-founders earlier, Rishi, and otherwise, that we often tend to look at the cheapness as a source of value. But how do you decide cheapness is not so easy. Okay, so so simply it's a very detailed. People just look at cheapness. How do you decide cheapness is also a very vast thing, and every cheapness cannot be value. Okay, every cheapness, as usually understood, that cheapness means value. Means every cheapness cannot be value. So these are very detailed things to look into. We'll look into that sometime later. But apart from that, I just want to understand that compared to the linear factors, there are so many non-linear factors as well in the market. Okay, so things are very complex. Things are very non-linear. Even recently we had the session that how non-linearity comes into picture into these factors and strategies. So how do you look at non-linear factors in this complex and
Right.
complex market?
Yeah. No, it's definitely, yeah, I would say the a lot of the research and even the tools, right? I mean, they assume linearity, they assume normal distributions in the data. I mean, you calculate a standard deviation, it assumes a normal distribution. Regression analysis, it assumes your errors are normally distributed. And so yeah, I mean, you need to keep all these, and that's in fact real life, and the markets don't behave that way. So yeah, I mean, there's certain, okay, I mean, certain types of models, like a, let's say, a logistic model, um, is good for certain things where you have a good idea of what the distribution actually is. So let's say default risk, if you're trying to you're building a model to try and predict, if a company is going to default or go bankrupt. Um, you won't use a kind of a traditional normal distribution or linear model. You'll use a different distribution in your model construction. So yeah, and again, linear, one of the things, if you're building a factor model, how do you weight your factors? Do you equal weight them? Do you put more weight on certain things because you think that they have more power in terms of predictive, predictive power? So um, these are all. That's why I say, it's as much of an art as a science.
Yeah, definitely, factors have a science because there have been of late the concept of scientific factor strategies where there are models, scientific models that how different factors play a role. Okay, how value leads to momentum and how momentum leads to value. And it's a lot of complex science also exists. Compare means alongside the art part. So 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 we have to understand that what exactly the scientific things along with the arts make it more prudent. So the point with risk management is that we were talking about non-linearity because I even coined that I see randomness itself as a factor. Okay, because because every time you come up with some factors and then in future there might come up some new factors that would be driving the market. Okay, so even these factors interrelate and they try to produce some new factors that one might not have thought before or modeled before. So that's where the non-linearity is. That how you prepare yourself to those unknown factors because some of the see all those FEMA, FENCH, and all those XYZ models. With due respect, that they are the kind of models, but somewhere you have to understand the unknown part that really tends to leads to the black swan kind of a stuff, and that could be quite dangerous. So you should have a model. You should have something that how do you prepare for those unknown nonlinear factors based on my understanding, okay, and based on my experience. And the point is that we often look that people talk about outperformance and alpha and all those things. That's quite good, but as you rightly talked about the normal distribution and those fractal distributions, we tend to somewhere overlook the true hidden risk while calculating the odd performance. Okay, because some of the popular risk metrics are not they have been empirical evidence that they don't work very um, prudently. So outperformance is good, but not just on the return part, also on the risk side. And risk doesn't mean only on the traditional um, uh, normal distribution type risk that we talk about. Those hidden risks, how exposed you are to those unknown risks, that should also be taken into consideration while truly capturing the outperformance rather than just showing that this is outperforming, we are creating alpha,
Yeah,
that kind of stuff. What's your view?
exactly, Pankaj. This is another thing which, the way the market behaves and which stocks outperform. It's often very different in a bear market versus a bull market. Or, whether these are regime, like, a lot of effort has gone into regime models. So we figure out that we're in a particular type of regime, particular type of market environment, and these factors will work. But now, if there's a shock or, things change, now you're in a different regime, and it may be different factors, or, you may manage your risk differently. So, yeah, no, this is the market is always changing, and so yeah, you kind of need to know, like, obviously momentum, for quite a while was a good factor, and if you um when but when the market's going down, you have to start looking at other factors. So and this, yeah, again, this is one of the different ways of constructing models, and you should just, search and use as many, or look at as many different tools as possible.
Yeah, great. Coming to so once again, uh, how do you see the future of this quant and factors based on your global experience you have? What was your experience at the global institutions while being a fund manager? And how do you look at India from that perspective?
Yeah, I think it will increase. I think that as long as you have, I mean, you have smart people working for fund managers, and if the performance is good using these models, it'll just become more and more popular. I mean, it'll never become 100% of the market. There's always going to be stock pickers and fundamental, we say bottom up or fundamental type of managers, and they are very good. I mean, they can be very good when you have a let's say a concentrated portfolio of 20 stocks or something like that, and sometimes they can deliver very good performance. But I'll give you, again, another example of why quant I think will just continue to grow and be more popular is the scale. It's easy to scale. So we had a team of, and not everyone was a fund manager. There were some couple of marketing people, there were admin assistants. Um, we had a kind of a middle office, trade, settlement processing type of person. With about, I think it was about five fund managers in our team of 10, but about five of us were actually running the funds. We were managing, I think it was at the peak around $20 billion, right? So you can figure out, again, I always can't turn that into crore, but that's a huge amount of assets with very few people, and it's because we're using systematic processes, and we could run very efficiently. So yeah, I think that it'll grow in the Indian market also.
Definitely, it has just started, and how people use it, how people take the benefit of technology, models, and all those things. It depends upon the person to person. But definitely, quant is quite going to be very, very hot topic and popular to improve on the on the traditional style as well. So, let me ask you. This is very popular thing that is going on. People with the rise of a smart beta and there's a things are going on between active versus passive and all those kind of stuff. How do you look at it? Means from your personal perspective and based on your experience, this conflict between active and passive kind of thing.
Right. Yeah. So, I mean, one of the firms I worked for was State Street, and I was on their active side, but they also have a huge passive business. And so, when I say passive, these are index trackers, and ETFs. Most ETFs are index trackers, and it doesn't have to be. It can track any index. So it could be a broad market index like the Sensex, or it could be an industry. It could be, you could have an ETF which just tracks the industry. Um, but the point being is that they just passively try to match the performance, and so costs tend to be a lot lower. This is one of the big arguments, for using passive, is that, if unless you're very smart, it's hard to beat the market, or some people will say you can't beat the market over the long term. So then you want to reduce your costs as much as possible, and then just buy an index fund, and you'll get the market return. Um, so it falls on both sides. Some people say, well, then, no, we can beat the market. We can deliver, additional performance above what the market gives you. And this is the foundation for active fund management. So I think, that the active fund managers have to produce enough alpha to outweigh their extra cost. Okay,
Yeah.
so and quant, and that's again, when it was a fundamental approach where you had to have, big teams of analysts and everyone is, looking at a handful of companies and you're meeting with management and you're touring factories and whatnot. Quant is actually a pretty cost efficient way of managing, a large a number of companies, a large asset base. So yeah, I mean, this is where quant also becomes, more competitive, I would say, with passive.
Yeah, so few things to add to what you said, that alpha does not mean just return. It has also to be from the risk side. Okay, because we often tend to forego the risk side and just look at the return side to measure the outperformance. And this passive and active comes originates from this entire efficient market hypothesis long back, that whether it is possible to beat the market or not. But the point is, we have to understand that these days even the index, or there are n number of indices. So it's not so easy that you just follow. Yeah, suppose you want to follow the indices, which index you are going to follow? Even the indices are many. So it's not that simple even for passive people, that I'm just sharing my views, that see, definitely active and passive both are exist, both have their own importance, but simply uh, just following the passive is not that easy, because we have so many indices to select from. And many can be created as well. Okay, so that's also a huge universe in itself. So it is not going to be easy for even the passive kind of strategist. So what's your take on that?
Yeah, well, so yeah, you can create your own index. In fact, I had spent some time working for a manager that wanted to do active ETFs, and that essentially they created their own custom index, and then they tried to match that index, and that's how it was active, was the fact that um, they were trying to match the performance of something that they created. The index was, developed. It came out of some type of system, management, like fund management process. So that was in fact an active ET. That's an active ETF. Um, and we see this a lot with, but on the purely passive side, right? Like you have to pick something. So an India country ETF, they'll have to pick like MSCI India. They'll pick a broad index to try and track. Um, Sometimes it's easier and sometimes it's harder. I mean, once you get into like a small cap index, in a less liquid countries, then you can decide to that's you can buy that ETF. But yeah, it's not always clear what is the best measure. If you're looking for, let's say you want to invest in technology stocks. There are going to be hundreds of funds that say, that there are technology ETFs. Which one is the best one? Each one will have their own kind of sector biases or, market cap biases. So yeah, it's not always clear. And uh, yeah, but the other thing too is that, uh, uh, yeah, yeah, it's not always clear.
Yeah,
And yeah,
yeah, definitely. When I was talking to one of the famous Nobel laureate, I had a deep discussion with him. We often tend to follow the benchmark and all those kind of thing, but we often ignore that there is a benchmarking risk as well. Okay,
that's
when
right.
we try to we try to outperform a particular benchmark, but we have also to be careful about the benchmarking risk that comes with the following the benchmarks. So you have to be pretty careful, because simply blindly following any index is good for showing your outperformance, but it may not work always for the long time, as far as your compound means wealth creation is, and the risk management side is concerned. So we have to be very careful on that. So that's a detailed topic in itself. So let's anything else you would like to
Yeah,
talk about, Chris, so that we could take a few other questions maybe from the audience.
sure. Yeah, I mean, so when a market is going up for a long period of time, there tends to be a lot of pressure to switch to passive. Okay, so because the market's doing well, if the market is generating 20, 30%, year after year, it is hard to beat. It is hard for active managers to beat that. And so there will be a lot of pressure to just buy a fund, buy an index fund and just, ride the market up. Now, when you're in a more volatile period or when you're in a bear market, then the active management starts looking better because you're not losing as much. I mean, that's the goal, is you're not losing as much as the index. And so you'll hear managers say things like, we are always fully invested in the market, we don't time the market, um, we don't maybe we don't change our factors, we're steady, we do the same process. But when the market's falling, then a little bit of market timing, or putting more money into cash, or hedging. Normally when the market's going up and you're hedging, and that's a cost, and it's costing you, and you're losing some performance, right? But when the market's going down, now all of a sudden say, well, gee, hedging is not such a bad idea. So yeah, it depends on what environment we're in.
Definitely. But for example, if when we talk about the beta thing, to beta of a fund or something like that, we have to be very careful that beta is not so linear while market is going up and market is
Oh,
going down. So this
not at
this
all.
representation, that simple beta of XYZ fund is this. It's a I personally think it's superficial kind of analysis. We have to go deep into the dynamics. And for passive strategists as well, it is not going to be very easy because with the rise of so many indices, maybe means the future is going to be when you have to create the portfolio of indices. So again, you will get into the problem of like portfolio of stocks. You will have to make the portfolio of indices. So it is not going to be so much easier even for passive strategists. But definitely both have their own plus and minus. So I won't comment on that. Uh, so let's take a few questions from the audience and then we wrap up. So, audience, hope you enjoyed it. And if you have any questions, please, you may open your video and then or audio, and you can ask the questions if you have any questions.
Pankaj, one of the topics I think we've thought about speaking more about, was machine learning, AI,
Yeah,
machine
yeah, yeah,
learning,
yeah, yeah,
right?
yeah.
And
Please, please,
so,
please.
yeah, and this again, people think either
And
people
and
have a,
one more thing I just wanted to add, that if for machine learning and artificial intelligence or quant, it's not just about a stock picking. It's also about the portfolio construction. How do you construct your portfolio? How do you manage risk? So at different stages, you have the role for quant, AI, and ML. Yeah. So please continue.
yeah, yeah, definitely. It can be used in a lot of different ways. I mean, people either they have a big kind of distrust of it, or they think it's a magic wand and it can solve all problems. Well, it's again, it's just another tool. But one of the real strengths of machine learning is it can take in a lot of information. So if Quant can, a quant process, you can say, well, I have, five factors, and it allows me to pick, uh, look at thousands of stocks and try to pick the best 50 or 100 stocks. All right, that's a power of a quant model. But if you have, you know thousands, you could potentially have, as much data as you want, and then it becomes impossible for a human being to really look at it and make sense of it. So this is where the power of machine learning, where you plug it into, that's in fact, the more data, they need a lot of data. And so And so, yeah, and then there might be patterns which aren't obvious, or, you might not be able to pick it out visually, or, just the volume of data is so much that it becomes harder and harder for, a human being to process it. This is where machine learning can sometimes find the hidden patterns in the data. So yeah, that's where I don't think it fixes every problem. I think it can be a useful tool.
Definitely, but see, we have the human, as a human, we have positives, but we have some limitations as well. So we can handle, say, for example,
And
50 data or the 100 data. But if you have millions of data, and then it becomes quite, then it's not practically possible for human mind to analyze the data. So definitely, their
right,
artificial intelligence and machine learning are quite useful, and it has to be complementary to each other. Both have their own plus and minus, pros
right.
and cons. So that has to be leveraged.
Yeah, definitely. And as I mentioned before, and this is actually it's a big problem, it's a big thing to overcome, is that, if it's working, well, first of all, every client, you have to explain your process, your strategy, and they have to, it has to make sense. If it doesn't make sense, they won't invest. And one of the challenges always with machine learning is, it's always seen as kind of a black box, right? Nobody knows, the data goes in, then the signals come out the other side. Nobody knows what happens on the inside. You have to really understand these models to be able to explain and, kind of make sense of it. And especially if you have good performance, everyone is happy. But if all of a sudden you start losing money and it's this black box type of model, then you start to have problems with the clients, and this is always something. I think, quants, we tend to think, oh, we'll just build a great model and it'll have great performance. But you need to interact, and you need to have a very kind of close and, open relationship with the clients, and help them understand, if they're sophisticated and they're used to using quant, then that's an easier conversation. But a lot of clients, you have to help them understand. You have to kind of educate them, and hold hands. And so, yeah, and this is where, every time we get more complicated, more complex models, more complex tools like machine learning, you've got to make sure that they're comfortable with it.
And definitely, and and one more thing I would like to talk about the artificial AI and ML thing, that there are definitely limitations of AI and ML as well. While it is quite useful, particularly related to uncertainty and randomness part. So artificial intelligence and machine learning are quite useful when you talk about predicting and all those things. But there definitely exists some unpredictability and randomness component as well. So there you have to be very careful. Even AI and ML is not so much prepared to handle those uncertainty and randomness. Even human is struggling. So okay, so one has to be very careful on that front as well. So definitely everything has own pros and cons, and we have to look in a complementary way to create a win-win situation for everyone. So I hope any question from audience. If you have, please feel free to ask. Open your video and you can ask, or else we'll stop the session.
I People, I think you're on mute. If you can unmute your mic if
Who?
you have a
Sorry.
question. It looks like people
Yeah. People, please
needs to
unmute yourself and then
unmute.
please ask if you have any question. You are not audible. You are not audible, people. You're not audible. Please unmute yourself. Okay, he's not able to unmute.
Sure.
Okay, so
If you
please
can
write down
type.
in chat. Please write down in chat if you have any question. You may
Oh,
write down your question.
allowed. I don't know if you've muted everyone or they can unmute themselves. No, you haven't muted everyone because I'm off
If you
mute.
are able
So
to, people, if
yeah,
you are able to ask in the chat, you can do that maybe.
yes.
Pankaj, there is a Q&A session where people are asking questions. You can refer that session, and we can ask those questions to Mr. Chris.
Sorry, please come again. Your voice, please come again. Sorry, people. Okay, so Bipul is talking about that. Chris, can you please focus on the quant market globally and India? A brief comparison.
Yeah. Uh, sure. Well, it's again, I've seen it evolve and become more popular. Definitely in the U.S. and Europe, it's become. I'd say it probably has more than half of the assets under management are managed with a quant process. Um, India, it's still a bit earlier. Um, but now we're seeing with the market the way it is, I think there's going to be a lot more of an argument that, how do you pick, if the market's going down, how do you pick the few stocks that still have good performance, or how do you pick stocks that don't go down as much as the broad market, so that you have some outperformance. I think India is a very sophisticated market, and very kind of tech savvy, and mathematical. Uh, you know People are very, I'd say people here are very hungry to do, use the kind of the latest technology and the latest the latest research. And so I think, yeah, I think the opportunities are going to be big, and I think has a pretty bright future going forward. That more and more funds will be managed with quant.
Yeah, and definitely AI is not just for prediction. As I already mentioned that there are a lot of things that AI can do. It's not just about prediction. Prediction is just one of the parts that AI is
Yeah,
often applied to.
and
Even
he's
unpredictable.
well. Sorry, Pankaj. Yeah, I was going to say, I mean, like, and non-traditional data too, right? Like, I mean, you've
Yeah,
seen
alternate data. Yeah,
yeah, hedge funds, certain sometimes like taking satellite photos, and a person could look at it and maybe try to say, well, okay, this means that this industry is going to be doing well, or this one is not. But that's the type of kind of new types of information that you can then feed to a machine learning model, and it will find things that maybe the human eye can't detect. So yeah, exactly, these kind of more and more data is being generated every year from it's there's more information, there's more data, and this, I think, just makes the case for using machine learning somehow. It just makes it stronger.
yeah, definitely. So AI multiple uses. It's a very vast area. Another question that comes that Naveen is asking, while building a factor model, how do you reduce the idiosyncratic risk in the model? Definitely we talked about non-linearity and all those things that comes from the idiom. So error part is also very crucial. So how do you look at this, Chris? While building a factor model, how do you reduce the idiosyncratic risk in the model? You can just talk very briefly.
Yeah, reducing what type of risk?
Idiosyncratic risks.
Oh, idiosyncratic. Yeah. Well, that again, you have to, you look at the different metrics of your model. And so, I mean, well, a factor model, if you have three factors, but they all behave the same way, that's not a useful model, right? So, you look at, the correlations across your factors, you look at the distribution of your error terms. There's autocorrelation, heteroscedasticity. I mean, these are all the things that you need to watch out for. That Well, yeah, heteroscedasticity is good, and when it's not, when you don't have that, then that's a problem. It means when there are trends, or that the errors are uh, dependent on each other, and yeah, so they're not random. So yeah, I mean, these are just things that you need to understand the statistical tools very well, where the pitfalls are, and it's never going to be perfect. You're never going to find, the perfect set of factors that, you there's always the risk that, overfitting, and, yeah, that's not giving you the best performance, but, you try to do the best that you can. And these are also always things that you need to watch.
So someone asked about the how do you look at some factors that work globally but not in Indian context. So as you talked earlier, for the
Oh,
different
right.
markets can have, yeah. So
Well,
can
sure,
you please?
sure. So, yeah, I mean, so for example, yeah, I mean, like oil prices, it might affect it could be a useful indicator. I don't know. I haven't really compared it to the Indian market, but it could say, like the currencies, maybe when the dollar, actually, there's a pretty good amount of research on the fact that I think it's, when the dollar is strong, then emerging markets in general tend to underperform developed markets. And, oil prices might hit more, certain countries more than others. So these are very kind of global factors, um, that, you could look at. It doesn't necessarily, well, then you could kind of go one level further and see, does it affect certain companies more than others? Um, but yeah, I guess these are the type, they're not India specific, but they could still be useful. If that's the question, I'm not sure if, yeah.
Yeah. So someone asked that how do you look at the some new factor, something for the emerging markets like India? You have anything to share with them?
Yeah, I mean, okay, so I again, maybe I need to, spend more time on,
Yeah.
India factors, but I can remember an example, years ago, when people didn't trust the Chinese economic data. And so if you were trying to use the big kind of major economic data, releases, but everyone thought that, like, they didn't trust that those numbers were accurate. So one of the things that people started using was electricity consumption, because this was a number that wasn't really controlled by the government. It was pretty, the number was out there, it was pretty transparent, and it actually was useful to say that, wow, the economy, people are using less power, so it's, the economy was maybe going to trend down. And so, yeah, you find data wherever you can find, whatever information you can find. um you know think about it. Does it make sense? Is it useful? Is it easily available? I mean, there's certain types of data which you can, there's data which you might have to pay a lot for. So is it worth it? I mean, I was talking about satellite photos, over the factories of the stocks that you're buying. um, and that you might have to spend a lot of money, and some hedge funds do, but you have to make sure that, the cost that you're making enough of a return to pay for the expense.
Okay, thank you, Chris. Uh, I think the questions are done. So, so, uh, so let's wrap up the podcast. And thank you everyone for joining, and thank you, Chris, for your time. And we'll have some more interesting people, experts in the next one. So, see you then.
Thank you, Pankaj. Thanks for moderating and the introduction and the interesting questions. And I want to thank everyone for joining tonight.
Yeah, thank you. Thank you.